Hello everyone, welcome back. This is part 1 of 2 of our videos related to types of income. So the reason why these are broken up is because we're going to look at some examples of income that we can see on the Form 1040. And then for some of them, depending on the type of income we're looking at, we're also going to look at a practice problem too, to kind of help reinforce some of the concepts. So high level, there are 2 types of income. Income from services and income from property. So services are considered earned income. And the reason why it's considered earned income is because it is generated by the efforts of the taxpayer. So probably the best example of earned income are our wages or our salary that we might get from our job. So something reported on a W-2, for example. The taxpayer had to work to earn that income. Income from property, on the other hand, that is considered unearned income. And the reason why it's unearned is because the taxpayer didn't have to perform some sort of work to earn that income. So examples of income from property can include gains or losses from the sale of property, dividends, interest, rent, royalties, annuities. And that type of income, it depends on the type of income and the type of transaction. So the first type of income we are going to look at is annuities. So an annuity is an investment that pays a stream of equal payments over time. And then with those payments, a portion of each annuity payment is a non-taxable return of capital. So we're recovering our initial investment. And then the remainder, if there is one, that is considered to be recognized as gross income. So what taxpayers will do is they will use an annuity exclusion ratio to determine the return of capital or the non-taxable portion of each payment. And this ratio is here, and I will make sure that this is on my chapter 5 notes page. So the annuity exclusion ratio equals the original investment divided by the expected value of the annuity itself. So whenever we think about annuities, there are 2 kinds of annuities. We have fixed annuities, and we have annuities paid over a life. And the reason why we want to distinguish between those 2 is because the calculations that we have to perform are different for each kind. So for annuities with a fixed term, the expected value is the number of payments times the payment amount. Whereas for annuities paid over a life, taxpayers must use the IRS tables to determine the expected value based upon the taxpayer's life expectancy. So let's look at some example problems to see the differences between the 2. All right, so our first example is an example of a fixed term annuity. So in January, Graham purchased an annuity for $99,000. The annuity pays her $10,000 per year for the next 15 years. How much of each $10,000 payment should Graham include in her gross income? So if our original purchase amount is the $99,000, so $99,000. And then we know we're supposed to be receiving 15 years of payments. So if we take 99,000 and then divide that over 15 years, that should get us $6,600 per year. And what this number represents is our return of capital, since we originally spent $99,000. So I'm going to label this as our return of capital. However, we know that this annuity is paying Graham $10,000 per year. So then if we take what we know, so Graham is receiving $10,000 a year. We know that of that 10,000, $6,600 is our return of capital. So we're recovering that $99,000 we spent. So then if we take the difference between the two, 10,000 minus $6,600, that leaves us with $3,400 that should be included in gross income. So our next example is an annuity over a life. So assume the annuity Graham purchased pays her $1,000 per month over the remainder of her life. Graham, 70 years old, paid $99,000 for the annuity, and she received her first $1,000 payment in December of this year. How much income would she recognize on that $1,000 payment? So whenever we looked at our fact pattern, we paid $99,000 for that annuity, so that'll be helpful for us later. And what we want to think about is how are we going to calculate the expected return for this annuity? So we're going to need a couple of pieces. First, we know that this annuity is going to pay $1,000 per month over the remainder of her life. So we'll need that $1,000 piece. So $1,000. Since that is a per month number, we will have to convert that to a year. So there are 12 months in a year. So we'll have to multiply by 12. And then we will also need what is called the expected return multiple. So in the textbook in Exhibit 5, that provides that expected return multiple that we will need to multiply our annual $12,000 that we would expect to receive, that $1,000 per month. So in the problem, it told us that Graham is 70 years old. And so if we look at the table in the age at annuity starting date column, if we find 70 and then we look to the right, we can see that our expected return multiple is 16. So 16. So then if we take $1,000 for each payment times 12 to convert it to a year, and then multiply it by the expected return multiple of 16, that will get us $192,000. So then, to calculate the return of capital, we're going to use that ratio from a few slides back, where we're going to take our original investment, so the $99,000, and then we are going to divide that by our expected return of 192,000. And that will get us a return of capital percentage of 51.56%. And so remember, the question that we're trying to answer is how much income would she recognize on the $1,000 payment? So this 51.56%, again, was our return of capital. So then if we take our $1,000 monthly payments and then multiply that by 51.56%, that gets us a return of capital payment of $515.60. So that is our, do not like how I wrote that there. Let's make that a little better. Okay. And that is our return of capital payment. So then, to get our taxable income per payment, that will be the difference. So, $1,000 minus our return of capital of $515.60 gets us $484.40 of taxable income to recognize. Our next type of income that we are going to look at is property dispositions. So, whenever a taxpayer sells or disposes of an asset, they will usually recognize a gain or a loss. And then whenever that disposal happens, taxpayers are allowed to recover their investment in the property, also known as the tax basis, before they realize any gain. And that all stems back to that return of capital principle that we talked about in the first video. So a formula that will help us think about this, and we're actually going to use this in the example problem on the next slide. So to calculate our amount realized, we'll want to take our sales proceeds minus any selling expenses, and that gets us to our amount realized. Then from there, we take that amount realized and subtract the tax basis or the investment in the property sold. And then that difference becomes the gain or loss on the sale. All right, so let's look at an example. On December 31st, Graham sold her 50 shares of Acme Corporation stock for $40 per share. Graham also paid $150 in broker commissions on the sale. Graham originally purchased the shares in April of this year for $30 per share. How much gross income does Graham recognize from the stock sale? So I'm going to highlight this here so we have our question that we're trying to answer. So this is what we're trying to answer. How much gross income should we recognize? So let's calculate a couple of sub numbers that we'll need real quick in order to complete the calculation. So for the sale, Graham sold 50 shares at $40 per share. So then in total, 50 shares times $40 per share, that gets us $2,000 for a sales price. The amount that she originally paid for them was $30 per share. So that's going to be part of her basis, what she originally paid for them. So here, I'm actually going to come back and label our first part. So everything in green here is our sales price. Yeah, sales price. Then in blue, so we have 50 shares times $30 per share. And then that gets us $1,500. And then this number is our tax basis. All right, so now if we go through that problem or that formula that was on the last slide and we plug in all of the pieces that we know, then we can go through and answer the final question. So let's get our amount realized number first. So our amount realized number, amount realized, we'll need our sales price or our sales proceeds. So that was the $2,000. And then in this particular problem, the fact pattern mentions that Graham paid $150 in broker commissions. And those broker commissions are considered a selling expense. So we will want to reduce our sales proceeds by those broker commissions. So $2,000 minus $150. That gets us an amount realized of $1,850. Then we'll want to take that amount realized and subtract our tax basis. And we already calculated that up here in blue. So we see that tax basis number is $1,500. So then the gain or loss on the sale, and then the answer to our question in yellow, we will have a gain of 300. Whoops, let me rewrite that. That did not look like a 5. I'm just gonna rewrite this whole thing. Sorry, guys. We are gonna have a gain on the sale of $350. So then $350 is the amount that we will include in gross income. All right, the last type of income that we're going to talk about in this video is income from flow-through entities, and we're going to have an example problem on the next slide. So we did talk about this briefly in chapter 15, but we're going to revisit it here in chapter 5. So in chapter 15, we talked about how individuals can invest in or own different types of business entities. And we also talked about how the legal form of the business affects how the income generated by that business is taxed. And so the different types of entities we talked about in chapter 15, there were tax-paying entities, and then there were flow-through entities. So our flow-through entities, if you think back to chapter 15, those were our partnerships, S corporations, and sole proprietorships. And with those flow-through entities, the reason why they're called flow-through entities is because instead of that partnership or S corporation paying the tax liability that is owed, instead what happens is the income and deductions of that entity flow through to the owners of said entity, and then the owners pick up their share of the tax liability related to that business. All right, so let's look at our example problem. Suppose that Courtney is a 40% partner in KJC Partnership. KJZ reported $20,000 of business income and $3,000 of interest income for the year. KJZ also distributed $1,000 of cash to Courtney. What amount of gross income from her ownership in KJZ partnership would Courtney report for the current year, assuming her tax basis in KJZ is $15,000 before considering the distribution? So whenever I look at the facts in this problem, the first two things that stick out to me immediately are the $20,000 of business income and the $3,000 of interest income. In this problem, since it says interest income and it doesn't explicitly mention that it's interest income from a municipal bond, we are going to assume that this interest income is taxable. Because as we talked about throughout chapter 1, I think even chapter 15 a little bit too, and in chapter 4 and in chapter 3, interest income from municipal bonds are not taxable at the federal level. So since it doesn't explicitly say it's municipal bond interest, we're assuming it's taxable. So these two numbers here, the 20,000 and the 3,000, are definitely going to be a part of the gross income. However, an important factor to keep in mind is in the problem, it mentions that Courtney is a 40% partner. What that signals is, okay, Courtney is going to be receiving something from KJZ, but only 40%. So then if we take the information that we know, let's start with our $20,000 of business income. Oh, sorry guys, I'm really bad at switching between highlighter and pen. So our $20,000 of income, let's start there. So KJZ Corporation, or partnership, not corporation, KJZ partnership, reported $20,000 of business income in total. Courtney's portion is 40%. And that gets us $8,000 as Courtney's share of the business income. Of the interest income piece, so KJZ partnership reported $3,000 total of interest income. Courtney's portion is 40%. So then when we multiply those two together, Courtney's share of the interest income is $200. Sorry about that, guys. So then if we add both of these pieces together, because both will flow through to Courtney, Courtney's total amount of income that she will report from KJZ partnership is $9,000. Sorry, let me rewrite that dollar sign. That looked really funky. $9,000. Gosh, guys, I'm so sorry. My penmanship is terrible today. $9,000 $200. So I know what you're probably thinking. What about this $1,000 cash distribution to Courtney? So for this, we want to look at this cash distribution in relationship to the basis. So here it mentions that Courtney's tax basis is $15,000. So when we talked earlier about tax basis, that is someone's cost or initial investment that they put into something. So since KJZ distributed $1,000 of cash to Courtney, cash distributions reduce someone's tax basis in a partnership. So then if we look at this and we see, whoops, we just calculate that out. So 15,000 in the starting basis minus the $1,000 cash distribution. That leaves us with an ending basis of $14,000. So since our ending tax basis is still a positive number, this $1,000 is not considered income, but instead it is considered a return on her investment. And when we talked about in that first video, that return of capital principal, the taxpayer has that right to recover their tax basis before having to recognize some sort of gain. So that's why this $1,000 was excluded. However, let's say that this basis was, I know it's gonna be really dramatic, but let's say instead that that Courtney's basis was only $950. And she still had her $1,000 cash distribution. That $50 difference between the two, that part would become a part of her gross income, because distributions in excess of the basis are taxable. So here, I'll add that part here. So that 14,000, or our scenario 1 and scenario 2. This is a return of capital. And then this is a return of capital to the extent of the basis. And then the excess over basis. Would be in, oh my gosh, would be in gross income. That was what I was trying to write. In gross income. All right, that ends the part 1 of this series. The next video, we're going to look at more types of income and certain calculations that could be related to that.